Hi folks, welcome back to a Forex trading course. And today we are in Forex Advanced episode 1. So far so good. We have covered Forex basics. We have also covered Forex intermediate. And that's quite a chunk of information that I've been able to share. I believe you are making notes even as you're studying, because whatever is not noted down, it's vapor. Ensure that you make notes. You have somewhere you can be able to refer what you have learned as you are practicing the same. Remember, I said in the last video that practice is what makes perfect. If you just read like a novel without practicing, without noting it down and practicing, it will definitely evaporate. You will definitely forget. So ensure you practice whatever we are learning. In today's lesson, we are doing what we call fundamental analysis. Remember, we began in the previous episodes, I've been looking at various types of technical analysis. We have been basically dwelling on technical analysis. And right now, I want us to shift and look at what we call fundamental analysis. And in today's lesson objective, you'll be able to understand what is fundamental analysis. You'll also be able to know how to check fundamental calendar. This is a calendar whereby they show various fundamental news that are scheduled to happen. You'll be able to understand various types of fundamentals and how they affect the Forex market. And particularly for this lesson, we are going to look at interest rates, we are going to look at inflation, and also employment outlook. However, as we shall see, there are other types of fundamental factors, and you will be able to know which they are, but we shall be able to cover them as we progress. So when we talk about fundamental analysis basically entails analyzing economic, political, and social forces that affect the demand and supply of a security. When I mean a security, it can be either a currency pair, it can be either a stock. So those are what we are calling securities. And demand and supply in Forex, it's very key. This is a very key concept that you need to understand. We shall also be going deeper into it so that you can know how the market is affected by the forces of demand and supply. Basically, we say that demand and supply affects the value of a currency. So the price of a currency falls and rises in response to demand and supply. Therefore, in a typical scenario, if a currency is demanded, this means that its value or its price rises. If a currency is in supply, it means that its value or price falls. Okay, so that's what you need to understand, how demand and supply affects the value of a currency as for now. Then you need to know that consumer spending affects money supply. So if we have consumers who are not spending, it means that there shall be no money supply. But if we have consumers who are spending, then this increases money supply. The foreign exchange rate of a currency reflects the supply and demand of that currency. So when you look at the Forex exchange rate, and this Forex exchange rate, it's what we say is the price, okay? So it reflects, when you look at the price or the foreign exchange rate, it reflects the supply and demand of that currency. How? We are going to see it as we look at various types of fundamental factors. Personally, I prefer using forexfactory.com to check the various fundamental calendar. As I said, we have various events or various fundamental news that are listed in the Forex Factory, and you are able to know that at a particular day, in a particular time, a certain event or a certain news will be able to be released, and therefore you are able to prepare yourself. Remember, some of these news are very volatile and they have high volatility or they have high impact in the market. And the reason why you need to know when these kind of news are expected so that you can do proper risk management or so that you can plan ahead of your trading. And if you have any positions that are running, you are able to manage them prior to the news, okay? So Forex Factory will give you will give you the listing of all those economic activities or news that are expected to be released. I'll be showing you how to go to the Forex Factory, how to navigate through the Forex Factory so that you can be able to know so that you can be able to see these events as they unfold. Also, in this video, I have shared the link the Forex Factory so that you can go there and check the various types of news that are listed, and you are able to see how these news unfold in the live market. We have various economic factors that help identify economic trends and how they affect their respective currencies. And they include, we have the interest rates, we have the inflation, we have the employment outlook, we have the monetary policy, we have the expectation of economic growth, balance of payments, capital flows, government outlook, among others. But for this lesson, I said, we are going to begin looking at the interest rates, the inflation, and the employment outlook, okay? So when we talk about interest rates, so we said that an anticipated interest rate hike by the central banks will make the currency value appreciate. Remember in the beginning when we were looking at the participants of the Forex market, we said that the central banks play a very key role in regulating the interest rates. Okay, so an anticipated interest rate hike by the central bank will make the currency value to appreciate, because when the interest rates increase, it means that currency price will increase as well, therefore making it to its value to appreciate. And this will make people to demand more of that currency, because people want to investors or traders want to be in an economy where the currency of that country is highly valued, or it has high interest rates for the benefit of making profits. Okay, so an anticipated interest rate fall leads to currency depreciation. So if we anticipate that the central banks are going to decrease the interest rates, then it means that we are anticipating the value of that currency to depreciate. And if we are anticipating the value of that currency to depreciate, then it means we are going to sell that currency, because you cannot continue holding a currency that you know it will depreciate in value. This means that if you continue holding it, you will be in losses, okay? Therefore, the reason why you need to sell it as soon as possible. On the other note, if we anticipate the interest rates to increase, then we are looking forward for the currency to appreciate. Therefore, as a trader or as an investor, you'll be looking to buy that currency, so that as the interest rates increases and the value of the currency increases, you are able to make you are able to gain value out of it. Okay, so everyone, including investors, are looking to relocate from nations with lower interest rates to nations with higher interest rates to make the highest returns. Okay, this can be looked also in terms of what we discussed about hedging, whereby we said hedging is a strategy whereby you put your money, or you put your currency, you put your money in a currency that you know is going to appreciate in value, such that when it appreciates in value and reaches a premium level, you are able to sell it back to the market at a profit. Okay, so that is why you see that investors want to relocate to nations where they anticipate that the interest rates is going to increase. Therefore, they will come and buy that currency because they're anticipating the increase of interest rates in that currency, which means the currency will increase in what? In value, okay? Therefore, Interest rates is among the significant factors in determining the perceived value of a currency. Just like I explained, you can see now the whole concept of interest rates, how it affects the value of a currency. Then we have inflation, which is very key. Right now, almost everywhere around the world, there is inflation. Prices of commodities and services have skyrocketed. And price stability is among the biggest influences on central bank interest rate decision. Okay, so when there is high inflation, the central bank wants to come in place and regulate inflation using the interest rates. So they make interest rates decision. Inflation, by definition, is a steady increase in prices of services and goods, and this is presented as Consumer Price Index or CPI in the economic calendar. Moderate inflation accompanies economic growth. So there is that inflation that is basically acceptable. So, and this comes with the economic growth. Like for instance, in advanced economies, the accepted inflation is between 1 to 2%. But inflation rates above 3 and 4% and above can represent overheating economy. This means that the inflation is very high. Inflation above the market expectation causes the currency to strengthen in anticipation for hikes in interest rates. Okay, so if there is high inflation, the central bank can only regulate the high level of inflation by increasing interest rates. And we saw that when interest rates increases, then the currency strengthens or the currency's value increases. So you can relate the concept of inflation and interest rates. So if inflation rates fall short of expectation, we anticipate the interest rates to be reduced. So if the interest rates are reduced, then it means that the value of that currency is decreased. Okay, it is decreased, meaning its price will decrease. Therefore, curbing inflation, the central bank uses interest rates. Okay, so you are able now to relate how inflation and interest rates relate to each other. Let's look at the employment outlook. And when we are looking at the employment outlook, basically we are looking at how it affects the demand and how it affects the supply of money as well. Increase in unemployment reduces consumer spending. Okay, this is because there will be many workers without jobs. And if you have workers without jobs, it means that these workers will have less money to spend on non-essentials. And in essence, this will increase the rate of unemployment. In essence, increasing the rate of unemployment signals a slowdown in the economy because there is no consumer spending, which will tend to slow down the economy. This will eventually lead to a possible devaluation of a country's currency because of the decreasing consumer confidence and lower demand. Okay, so if there is no consumer spending, it will lead to slowdown in the economy, which will also lead to devaluation of a country's currency, meaning that the currency of that particular currency will be less in value. It will be devalued. It will be less in value. And this is basically because of decreasing consumer confidence. That is, the consumers in that particular nation or in that particular country are not confident enough to spend because they are jobless. They don't have money to spend. And also, there is lower demand. Okay, if demand declines further, the currency supply builds up, which leads to more depreciation in exchange rates. So that is how we look at the employment outlook. And the employment outlook is actually a very significant a fundamental that affects the market. And this is not basically represented in the economic calendar as NFP or non-farm payroll. Okay, and you find that especially for the USD, it is represented as non-farm payroll, and particularly for the USD. And this data is released every Friday, every first Friday of the month. Like next week, it will be the first Friday of April. Therefore, we expect this data to be released, and it is very volatile and it affects the market in a huge way. So that being said, I want to take you straight to the Forex factory so that you are able to see the Forex factory and see how you are able to navigate through the Forex factory, how to see the listed economic news so that you can be able to plan your trades accordingly. Or if you're in trade, you're in position, you're able to manage your positions accordingly. So let's jump into the Forex factory website. So this is the Forex Factory website. And before, when you go to the Forex Factory website for the first time, you'll find that you'll see three types of news. Okay, you'll be able to see the yellow boxes, and with the yellow boxes, this means that the news that are listed in the yellow boxes, they have low impact. Okay, so as you can see, when you place your cursor there, it shows you low impact expected. The orange boxes will have medium impact. So these news will have medium impact. And then we have the red boxes, okay? That is high impact expected. So this one, it means that the market will be very volatile. The market will be very volatile. So basically for me, what I basically dwell in or what I am interested in is the high impact news. So the number one thing I do when I come to the Forex factory, you can see the cursor, you can see where it is written filter. So I basically go to the filter session and try to filter, okay? But before even I go to the filter, there is one thing that you need to understand. Apart from the three boxes, the yellow one, which shows low impact, and the orange one, which shows medium impact, and the red one, which shows high impact, we also have a gray box. We also have a gray box like this one, it's gray in color. And this shows that there is a bank holiday or there is no any economic activities expected. So basically it shows bank holiday in that particular nation, okay? So here you'll see the dates, here you'll see time, you'll see currency, and you'll see the impact. And then on the other side, you'll be able to see this means that is the previous data that was released. Then you'll be able to see the forecasted data. And then you'll be able to see now, once the news is released, you'll be able to see the actual. But with the previous and the forecast, you are able to have a rough picture or a rough idea of what is expected in the market, and you are able to align yourself in that direction. Okay, because with Forex Factory, it has proven to be 99% correct with their forecast, because this forecast is not just a forecast of an individual, it's a forecast of big banks, and then an average is done. So this is how they get the forecast. So as I was trying to explain, the first thing you do when you come to Forex Factory, ensure you set time. Okay, so you can see the aspect of time. You can see where my cursor is. We have time. So ensure that this time is set in your local time from wherever you are. My time is GMT plus 3. So I ensure that is at GMT plus 3. And then the time format, I set it in AM or PM. You can also do it in 24 hours, which is okay. Then once you're done, you click saving, okay? So the reason why we are doing that, it's for you to be able to know when these news occur in your time zone, okay? So that you can be able to prepare well. Because if you know that in your time zone, the time in your time zone when these news are going to occur, you are able to plan accordingly. It will not confuse you. So after you do that, you can come back to the calendar. You click calendar, and it will take you back to these news, okay? So the next thing you do, and I said that according to me, I don't like seeing these other boxes. Basically, what I love doing is I love seeing. I don't want to see the yellow and the high impact. I don't want to see the low impact and the medium impact because they really don't affect the market as such. So I'll come to filter, then I remove the yellow, I filter the yellow and the orange, and then I apply settings. So it should be for all currencies. Okay, so I have chosen here all currencies. Then all types of news or events. Then you apply filter. So once you filter, you will be able now to see the holiday and the high impact. Why are these very important? With the holiday, you find that the currency in that country, if for instance we have an holiday in, let's say, in the GBP currency, that means it's in UK. We have a bank holiday in UK. Therefore, it means that the GBP will not be volatile. It will be just moving sideways. Okay, it will be moving sideways. So I want to avoid entering trades that have GBP because basically they'll be moving sideways. There'll be no volatility. I'm interested with the volatility because it is out of the volatility that we make money as traders. So with this, like for instance, today is Friday. So Friday at 3:30 p.m., I'm expecting GDP news for CAD, okay, for Canadian dollar. And then at the same time, I'll be expecting the core PCI price index for USD. I'll look here at the previous, then the forecasted. Also for USD, the previous, then the forecasted. So if let's say take this core PCI price index for USD, the previous was 0.6%. The forecasted is 0.4%. Okay, so this gives me a value because a picture that the USD will decrease, might decrease in value. Okay, it might decrease in value because here we're expecting a decrease of core PCI price index, and therefore, if the USD might decrease in value, it means that any pairs that have USD as quote currency will buy, and pairs that have USD as base currency will sell. Okay, so basically that's how we do it. I don't want to dwell much on this because I will do another video that will explain how to position yourself in the market or how to look your entries in the market when we have such kind of fundamentals like NFP, like CPI, like GDP, as we shall be discussing them as we move on. So I'll do a comprehensive video that will help you, position you, or to guide you on how to trade during fundamental news. So for this lesson, it was basically to show you how to navigate in the Forex factory. So thank you so much for watching. Ensure that you subscribe, you like, and you share this video, and ensure that you are tuned in for my next video. Thank you so much. Have a wonderful day.